The water is pulling back. What Jamie Dimon's two words mean for silver. Somewhere in a wood-paneled room at the Council on Foreign Relations 2 weeks ago, the most powerful banker in America said something that should have rattled every silver holder on the planet, and almost nobody noticed. Jamie Dimon, a man who runs roughly $4 trillion in assets and has called more downturns correctly than any banker of his generation, did not give a routine interview. He gave what several analysts are now calling the most candid warning of his year, and he did it in 19 words. We're in a bull market. It's like a little tsunami. When that kind of thing happens, it's very hard to stop. Stay with me, because by the time this is finished, you will understand exactly why those 19 words, spoken almost in passing at a foreign policy discussion, matter more to the price of silver than anything printed on a chart. Consider first the nature of the metaphor Dimon reached for. He did not say hurricane. A hurricane announces itself for days, tracked by satellite, narrated by men in rain slickers standing in the surf. He said tsunami. A tsunami is the storm that arrives without a storm. The defining feature of a tsunami, the thing every coastal geologist will tell you, is that the water recedes first. It pulls back from the shore, exposing sand that has not seen daylight in a generation, and for one deceptive moment the beach looks wider, calmer, safer than it has ever looked. Children run out to collect the stranded fish, and then the sea returns all at once, indifferent to how pleasant the pause appeared. That is the picture Dimon was painting of markets in the summer of 2026, and it is worth sitting with, because it describes silver's last 5 months with uncomfortable precision. On January 29th, silver touched $121.62 an ounce, the highest price in the recorded history of the metal, a number that made front pages and group chats alike. Then the water pulled back. By late June, silver was trading near $58, having surrendered nearly 52% of its value in 150 days. Ask most people what that means, and they will tell you the silver story is over, that the mania peaked and popped like every mania before it. Tulips and dot-com tickers and beanie babies rolled into one shiny metal. That is the reading of someone watching only the tide table, not the ocean floor. Dimon himself never connected his tsunami remark to silver. He was talking about equities, about the S&P 500's 24th record high of the year, about the peculiar calm of a market that has shrugged off war in Ukraine, conflict in the Middle East, and a fraying relationship with Beijing, as though geopolitics were background noise rather than, in his own phrase, tectonic plates shifting beneath the visible economy. But tectonic plates do not confine their tremors to one asset class. When the plates move, everything built on top of them moves, and precious metals have historically moved first and hardest, because precious metals are the oldest insurance policy human beings have ever written against the failure of paper promises. Here is the mechanism, and it is not complicated, whatever the finance channels make of it. Interest rates, Dimon wrote in his own shareholder letter this spring, are like gravity to almost all asset prices. Kevin Warsh, the hawkish new Federal Reserve chairman installed in late 2025, has spent this year proving he takes that gravity seriously. At the Fed's June meeting, 9 of 19 policymakers penciled in at least one more rate hike this year, and traders are now pricing roughly a 62% chance of a hike in September. Every basis point of that expectation makes the dollar heavier and makes silver, which pays no interest and never has, comparatively more expensive to hold. That is why silver fell from roughly $70 to under $58 in the week after that meeting alone. Not because a single mine closed, not because a single factory stopped buying silver for solar panels or semiconductors, but because a committee of economists shifted its collective expectation about where a number might sit 9 months from now. Gravity, though, only tells you why a thing falls. It does not tell you what the thing is made of, and here the tide table reading of silver starts to come apart. While the price was falling by half, the physical market was doing something almost nobody was watching. It was tightening. The Silver Institute's own 2026 survey puts this year's global deficit at 46.3 million ounces, the 6th consecutive year in which the world has used more silver than it mined. Since 2021, 762 million ounces have been pulled out of above-ground stockpiles simply to cover that shortfall, stockpiles that do not replenish themselves the way a spreadsheet cell does. Mine supply, meanwhile, is not rising to meet the gap. It is forecast to dip slightly this year, to 844.1 million ounces, a rounding error against a deficit that keeps compounding. So you have two stories running at once, and they disagree with each other in a way that should make any serious observer uneasy rather than confident. The paper story says silver is falling because rates are rising and the dollar is strong. a story told in futures contracts, dot plots, and CME probabilities. The physical story says silver is getting scarcer every single year, drawn down ounce by ounce from vaults that are not bottomless, while institutional buyers, the kind who do not care about a headline, only about owning the metal itself, are reportedly standing for physical delivery at levels rarely seen. Andy Schechtman, who runs Miles Franklin Precious Metals and sells the stuff for a living, so weigh his enthusiasm accordingly, has said the biggest money in America is demanding real bars, not paper promises. Two stories, both told with real numbers, both incompatible over the long run. And when paper pricing and physical reality diverge this far for this long, history does not have a gentle way of resolving the disagreement. It resolves it the way a tsunami resolves the gap between a receded shoreline and the ocean's actual volume, abruptly and all at once. That divergence is where this story turns genuinely serious. It is also where the numbers start to sound less like a chart and more like geology arguing with a spreadsheet. And that argument is where we go next. There is an old fact among geologists that most investors have never heard, and it happens to be one of the more elegant figures in all of commodities. Silver comes out of the earth at a ratio of roughly 7 ounces to every 1 ounce of gold. That is geology. It does not consult the futures market. It does not care what the Federal Reserve announced on June 17th. It is simply the ratio at which the planet, over billions of years, chose to distribute these two metals through its crust. The market, however, currently prices silver against gold at a ratio of 64 to 1, not 7 to 1, 64 to 1, meaning silver trades as though it were roughly 9 times scarcer, relative to gold, than the ground actually makes it. Keith Neumeyer, who runs First Majestic Silver, and therefore has every commercial incentive to talk his own book, has been pointing at this gap since 2017, when he predicted silver would reach $100, while it traded at $17, and the world laughed at him. The world stopped laughing on January 29th of this year. He says the story is not finished, and geology, unlike Wall Street strategists, does not change its mind on a quarterly basis. Consider what that ratio implies at today's gold price. Gold sits near $4,200 an ounce. If the ratio merely drifted halfway back toward its long-run historical average of roughly 16 to 1, say, to 30 to 1, nowhere near a full return to normal, just a partial correction, silver would need to trade near $140. If Dimon's own more alarming scenario for gold, $5,000 an ounce, arrived alongside a ratio of 25 to 1, silver would sit near $200. These are not predictions. They are arithmetic, the kind of arithmetic that tends to embarrass people who mistake a 5-month chart for the whole of history. Now, before you take any of this as gospel, an honest accounting requires a confession that too many finance channels skip past. Nearly everyone quoted in this story has a stake in the outcome. Neumeyer mines silver. Andy Schechtman sells it. Mike Maloney sells it. Egon von Greyerz manages it. Eric Sprott's funds are built on it. Peter Schiff runs an asset management firm built on precisely this thesis. This does not make any of them wrong. A man who owns a boat is not disqualified from warning you about a storm, but it means their conviction and their commission arrive in the same envelope, and you are entitled to weigh both. What is harder to dismiss is the chorus of voices with no silver to sell. Ray Dalio, who built the largest hedge fund on earth without needing anyone to buy an ounce of anything from him, returned from 10 days in China this year and told anyone who would listen that global leaders increasingly doubt America's capacity to hold its economic empire together. What he has called the country's Suez moment, the instant a dominant power begins losing the credibility that props up its currency. Lynn Alden, whose reputation rests on rigor rather than metal, has tied persistent fiscal deficits directly to precious metals demand. When a government borrows this much and a central bank absorbs the debt, purchasing power erodes, and gold and silver, limited by geology in a way dollars are not limited by anything, tend to reflect that erosion in price. JPMorgan's own research desk, the very bank Dimon runs, has confirmed that China's net gold imports hit 317 tons in the first quarter of 2026 alone, nearly triple the prior quarter. De-dollarization is no longer a theory whispered at gold conferences. It is a customs figure. And Dimon himself, speaking this spring with the head of Norway's sovereign wealth fund, put the same worry in blunter terms than any shareholder letter usually allows. I don't know how the world running deficits like this isn't inflationary. That die may have been cast. It just hasn't happened yet. Read that carefully. The chief executive of JPMorgan Chase is telling a room of professional investors that inflation may already be decided, waiting only for the calendar to catch up to the arithmetic. If you have made it this far, you already understand this is not a 5-minute story, and I would rather lose the viewers who wanted a headline than shortchange the ones who want the truth. If that describes you, if you would rather sit with the uncomfortable, complicated version of a story than the tidy one, this is the kind of channel worth staying subscribed to, because we intend to keep pulling these threads long after the algorithm has moved on to something shinier. Hit that subscribe button now, not because I am asking you to, but because in 6 months when this plays out one way or another, you will want to have been here for the parts nobody else was willing to explain. Because here's the part that should genuinely unsettle you, whichever side of this debate you land on. The people forecasting silver's future are not a fringe of bloggers shouting into the wind. JPMorgan's own commodities desk, again, Dimon's bank, is forecasting silver to average $81 an ounce this year. Citigroup has a $100 target. BNP Paribas, independently, arrived at the same $100 figure. A Reuters poll of professional analysts published in February put the consensus at $79.50. These are not people who sell silver in a shop. These are institutional research desks with staffs of economists and reputations that depend on being right more often than they are wrong, and they are all, independently, looking at a metal trading near $58 and concluding that the market may have mispriced it by 40% or more. 6 consecutive years of deficits. A gold-silver ratio that geology says should not exist. A Federal Reserve chairman who has staked his credibility on fighting inflation with rates, even as his own bank's research desk is quietly forecasting a price well above where the metal sits today. This is not a simple story. It was never going to be. The next question, the one that actually matters for the market open ahead, is which of these forces wins first? So let us be honest about what comes next, because honesty is the one thing missing from most of what gets said about silver on the internet, and it is the only thing worth offering you here. The bear case is not a straw man. It deserves to be stated in full, not dismissed to make a better story. The Federal Reserve has all but told the market to expect a rate hike as early as September. The dollar has been climbing on exactly that expectation. Inflation, measured by the Fed's preferred gauge, accelerated to 4.1% in May, the kind of number that hands Kevin Warsh every political justification he needs to keep rates high, deficit spending or no deficit spending. If that hike comes, the technical floor for silver sits somewhere between $55 and $60, and if that floor cracks, the next real support is closer to $50. TD Securities, in their most cautious scenario, has silver averaging just $44 for the year. That is not a small drawdown from here. That is a genuine, well-reasoned case for further pain, made by people whose job is to be right about exactly this. The bull case is equally real, and pretending otherwise would be its own kind of dishonesty. 6 straight years of deficits do not reverse themselves because a Fed committee changes a dot on a chart. The 762 million ounces already drawn from global reserves do not return to the vault. Solar installation, electric vehicle production, and the data center build-out feeding the AI boom that Dimon himself cited as a reason markets feel calm, all of it consumes silver in quantities that have no substitute at scale: war or peace, hike or pause. JPMorgan's Greg Shearer has noted that if tariff talk around silver reignites, physical liquidity outside the United States could tighten sharply in ways the current price does not remotely reflect. And industry researcher Jeff Clark points to U.S. retail demand for silver coins and bars surging an estimated 57% this year. Ordinary savers, not hedge funds, quietly voting with their own money. History offers a pattern here worth remembering, even if history is a notoriously unreliable prophet. In 2008 and again in 2020, when equity markets cracked and central banks scrambled to respond, the sequence was strikingly similar each time. An initial indiscriminate sell-off in which investors dumped everything, silver included, to raise cash. Then a policy pivot, as central banks cut rates or opened the spigot. And finally, once the dust settled, a silver rally that outran almost every other asset in the recovery, because silver carries 2 identities at once: an industrial metal tied to factories and solar panels, and a monetary metal tied to trust in currency itself. When both identities catch a bid simultaneously, the moves are rarely gentle. Whether that same sequence is beginning now, or whether this cycle simply breaks the pattern, is precisely the wager every silver holder is being asked, without being asked directly, to make. What Dimon actually said was never a prediction about silver specifically, and it would be dishonest of me to pretend the most powerful banker in America went on record calling a bottom in a commodity most of Wall Street barely tracks. What he offered was something more useful than a prediction, a description of the psychology of a moment. A market that looks calm because the water has pulled back. A public that mistakes the pause for the new normal. A set of risks, Ukraine, Iran, oil, a fraying relationship between the world's two largest economies, a Federal Reserve chairman determined to prove his hawkish credentials at the very moment fiscal deficits keep growing, that Dimon himself says the market is simply choosing not to price. That psychology does not stay confined to the S&P 500. It has never once, in the history of modern markets, stayed confined to a single asset class. There is a version of this story where $58 silver is simply the truth reasserting itself after a speculative spike to $121, and everyone who bought near the top learns the oldest lesson in markets, that trees do not grow to the sky. There is another version where $58 is the receded shoreline, the moment before the moment, the pause a tsunami always offers before it stops offering pauses at all. Both versions are argued right now by serious people with real track records and real reputations at stake. Neither version is a certainty, and anyone who tells you it is has already decided what they want you to do with your money. What we can say without hedging is this. The deficit is real, and it is in its 6th consecutive year. The gold-silver ratio is real, and it sits nowhere near where geology would predict. Dimon's own words about deficits and inflation are real, on the record, spoken to a room of professional investors. The Fed's hawkish dot plot is real, and the fact that institutional desks at JPMorgan, Citigroup, and BNP Paribas are all, independently of one another, forecasting a price meaningfully above where silver sits today, that is real too, whatever happens between now and December. So here is where I leave it with you, because this is not a story with a tidy ending, and I think you deserve better than a fake one. Is $58 silver the sound of a bubble finally deflating, the market correcting a mania that ran too far, too fast back in January? Or is it the tide pulling back before something larger arrives, the exact pattern Dimon described without ever once mentioning silver? I do not think the answer is obvious, and I would not trust anyone who tells you it is. Tell me what you think happens in the second half of 2026. Not what some analyst on a finance channel thinks, what you think, looking at the deficit, the ratio, the Fed, and a banker who runs trillions telling a room full of professionals that the die may already be cast. Put it in the comments, because the honest version of this debate is not happening on the cable networks, and I would rather build it here, with people who read past the headline, than pretend I have an answer I do not have. And remember, this is for education and discussion only, not personal financial advice.